Hello, this is the tutorial class for lesson 1. We're going to look at the slides again and I'm try to combine this with some practical knowledge which will help you to understand better what the slides are about. The first lesson was about the hidden structure of markets. So, well, we're talking here about fractals, and I think another good example is basically if you look at snowflakes, right? A snowflake has a certain structure, and if you zoom into the snowflake, you will see that the same structure is repeating. This concept is important because once you understand that these patterns can repeat, you might come easier to the conclusion that the same can also exist within financial markets, or let's say this is what we actually see in financial markets in form of waves. If we have a wave structure, which is 5 waves up, 5 waves down, you can zoom into those waves and you will see that on a smaller time frame, this 5 wave structure is repeating over and over again. Why is this important? This is important because once you understand that the financial market structures are not random, that they're repeating, you can have a higher chance of catching market structures by predicting the move of the structure, right? So once you understand that, oh, on a daily time frame we have a 5 wave impulsive structure, you can zoom in and you can expect it. Okay, now what should follow is this wave with this structure, or if a structure on a smaller time frame on the 12-minute chart looks impulsive with 5 waves, you can assume that if you have a retracement, the next move might be impulsive to the upside and it's higher chances to enter the trade to be profitable. This is basically what the first slides are about, to kind of give you understanding on what the whole TI system is based on. So this is not just like, oh, we think waves are cool or whatever, but no, this is really a pattern that always repeats. And also you will hear a lot about illegal waves here and there. Some people believe it, but believe it not. But it's a fact that waves move in the waves moves in 5 waves, and that's repeating. You will, once you finish the course and you look at charts, you will see that this is true. So, and once you understand this, we hope that you basically are more convinced into the system that it's working. These waves then also are impulsive or corrective. What does it mean? An impulsive wave means that the impulse of the wave is strong, which means the wave, or let's say Bitcoin, goes quickly from 50 to 100K, right? That was a very impulsive move, while now it's kind of like dragging along for like half a year. We're just waiting and it's coming down, and now it's from 60 to 80K. It took, I don't know, like 5-6 months, right? It takes a really long time. So that's not an impulsive move, that is more a structural move. You also see a lot of impulsive moves right now in the NASDAQ or in some certain stocks where it's like, well, these stocks are shooting up, and you wonder why is that? It is because they're in an impulsive wave. What we don't want to talk about now is the Fibonacci tools and levels, how we use it, because that's what basically lesson 2 is about. I will show you in the second lesson, or in the second tutorial, I will actually kind of show you how to use these tools, and you will see it's pretty easy once you have set it up. And then what are the liquidity flip zones? The liquidity flip zones are where the market turns. Why is that important? The market turns because there is demand, right? So people are buying or selling. In these liquidity flip zones, we have parts where buyers and sellers are coming together. So let me actually show you this in Bitcoin. So once we identified the waves, right, we have like 1, 2, 3, 4, 5 down. Then you kind of look for areas where you think the market might be able to turn. Why did we draw these waves like this? In here we have a corrective structure, and you can see this is an impulsive wave, right? It went really quickly down from 90 to 60K. It went down without it, and now it takes a long time. So we're assuming based on these factors that this is also wave 4, and so far we saw a structure of A, B, C. This point of where the market was turning is a liquidity zone. Why is that? Because we have a Fibonacci level of 78.6, which is the retracement from here, from wave 2 to wave 3, right? We have retracement levels, which matches up here. And then we can predict, once we have wave 1, wave B, wave C, we can predict with the Fibonacci extension level that the market goes from point 0 to point A to point B. We receive, sorry. So I need to activate the Fibonacci one. You can see that this level ends up here. And in the next session, I will talk to you about, because right now I just drew it pretty quickly. You kind of barely have to put it exactly on the points. A, B, right? So you can see it matches up. See. See, yeah. That the 1 point level. Yeah, you see. So you can use the command tool to bring it really up to here. And then you can see that the 1 point level matches the 1 point level. And then we know this area, let's zoom in, is interesting for us, right? So we can see it actually hit exactly 0.86. I mean, if you think that's random, that's up to you. And we also hit the 1 point level. So in this area, it was very likely that the market will turn. Why is that? Because you have people taking profits here, right? So if you went long in for this move, you would take profits here. This is what the class was about. At point 1, at point 1.2, 1.68, we will always take profits. So you have a lot of people selling here just to take profits, to be on the safe side. On the same level, we also have people entering shorts at this level, because this is an interesting level to short. It is wave 4, right? This is wave 4. And the highest point wave 4 can go is 0.786. If we would have gone higher than that point, it would not be wave 4 anymore. If we would have broken through, we would have treated this not anymore as wave 4. We would basically have treated this as a new impulsive wave structure 1, 2, 3, 4, 5 up. And we would have treated this as A, B, C, and the correction is over. However, since this whole structure is not impulsive, because it doesn't look like this, we assume that this is wave 4, right? It looks from the structure, it's telling us this is wave 4, and all these reactions over here prove it. What you also need to understand with the system is, right, it's not a money printing making machine, because what can happen is, let's say Donald Trump says now, or the US says now, oh, we're going to put the Bitcoin reserve together, we're going to buy 1 million Bitcoin. Bitcoin would instantly shoot up, right? Just because the system is in place, it doesn't mean that this cannot happen, right? So once that happens, we have a new structure, we have to adapt to the structure, and then we have to kind of trade. So everything can happen at any point. So this is why you use stop loss, and you have to basically protect your capital, because if their buyers or sellers step in, the structure will change and you cannot change it. So no system in the world can protect you from this, because we're still trading at markets where you have people buying and selling, and they can also control the market. However, if you look at this, you will see that a lot of times, right, if you look at this, you can see at 61.8, the market turned, we have a wave C went exactly to there. And you can see this over and over again, that these levels are always repeating. And this is basically what we call the liquidity flip zone. Yes, and this is basically what lesson 1 is about. We just want to put it together for you, that you understand the TI system is based on kind of like evidence that structures repeat, and this is why you should not trust the system, or why you should at least accept that this is kind of what exists in the nature, and it exists in financial markets, and that this structure, to understand, is the basis of all knowledge, right? Once you understand this, your mind will change from, oh, the TI doesn't work, the trade or charts don't work, trade analysis doesn't work, it's all random and so on. No, it's not all random. No, this works. And what you learn in the system is, even if you make changes to the system for yourself, or you look for other systems, all the knowledge you will learn here is very, very basic knowledge, which you should keep in mind. And the fractal structure is what is this repeating pattern, and which is for financial markets in waves. We will use the Fibonacci's, and then there's liquidity, which is basically, of course, the driver at markets is money. And yes, once you understand this, you will have more conviction, or you will have more how should I say, right? Because maybe you don't believe in this, right? Then maybe this system is not the right system for you. But once you understand this structure, and you will be like, ah, okay, cool. This is why everything, the markets are moving this way. And if you be like, oh, this is just random. No, it's not random, because here it's the same for silver, right? In silver, we had the same situation, right? We have here, this is the wave 5 prediction. It went to 85. We have the retracement level of 78.6, and exactly at this point the market started to turn downwards. So once you understand these waves and how to draw them, because they're not randomly drawn, right? They're like within the waves. We want to see this structure through the fractals, which allows us to be like, ah, this is wave 1, this is wave 2, so this should be wave 3 with a down target, and this should be wave 4 with a target, and this should be wave 5 with a target of $58. So now we're waiting, or we're short in this trade, so we're waiting basically for silver to go down here to then go long. And this allows us really to catch really long, broad moves. So we hope that you also will start to accept and look at this way, and it will really, really help you to trade more profitable, or at least don't feel that loss, that you understand why is it going down. Another good example was hype, right? Within hype, we always said, wait, we are here in an impulsive way up, right? We're here in an up move, but people are like, oh, why is it not going down if Bitcoin is going down? Because we're in an impulsive up structure. So hype will not go down even if Bitcoin will go down. So yeah. And yes, this is, we hope this is all will make sense, and this is just lesson 1 to basically summarize it from my conviction, or how I learned it and accepted it. And for me, it was really like a moment where someone turned on the lights and was like, oh, okay, great, this makes finally sense. And so in the next lessons, we will explain you the tools. It's a Fibonacci tool, which is very easy to use. We will explain you what characters the waves are having, and then what volume is, what the MACD is, and yeah, so that you kind of like are ready to trade it. And of course, you can always look at our setup and structures, and even if you find more indicators, you can always include them. Where this is also what we're going to talk about a little bit later, which is then when it comes to Confluence. So that's why I said this is the basics you need to know. And if you want to expand it with more indicators, then great. Because of course, if you have more indicators showing you that the market might be turning here or might be turning there, that's called confluence, and then you have even higher chance that your trades are working out. So yes, we're excited to have you here, and we hope you're excited to learn this with us. And yep, this is the tutorial 1, short and quick, and I'm excited to be back for the tutorial to the second lesson, where we actually start drawing these charts and also start using, I'm showing you the settings for everything. Perfect. Take care.